Recent changes to mortgage regulations by the Biden administration have ignited a fierce debate within the real estate industry and among financial experts. Taking effect this past Monday, May 1st, the new Federal Housing Finance Agency rules aim to level the playing field for homebuyers with varying credit scores, promoting greater accessibility to mortgages and homeownership opportunities for underserved communities. However, critics claim that responsible homeowners and potential buyers with good credit are being unfairly penalized, sparking concerns about the long-term consequences of these changes. To learn more about these changes and to get a better understanding of what is going on, I sat down with real estate professional Charlotte Green to explain what's happening and whether or not we should be concerned. Starting off, what are the pricing adjustments that have been made starting this week?
So these were announced in January, and loan level pricing adjustments affect an interest rate that somebody pays. We all start out with the same base interest rate, and then we apply pricing adjustments, which are also referred to as risk-based pricing adjustments, to increase an interest rate or cause a borrower to pay points. So those were put in place in 2008. Like I said, these changes were announced in January. They're getting a lot of fanfare like never before. And what they're doing now, they're looking to redistribute these pricing adjustments a little bit more equitably across the board. So a lot of the narrative has been that now higher credit borrowers are going to be, paying a higher interest rate than a low credit borrower. Those high credit borrowers still are going to have lower pricing adjustments than low credit borrowers. We're just seeing that spread from top to bottom narrow a little bit more with these changes.
What are the primary reasons that they're making these changes?
The primary reasons for these changes are to make housing more equitable for lower and moderate income borrowers. There have been a lot of studies over recent years that credit score is not as strong of a factor in somebody's ability to repay and their overall risk profile. I don't think the FHFA is quite on board with that yet, but there's a lot of discussion around the industry. So what we're seeing now is a little bit more equitable application of pricing adjustments for people on the high end to the low end of the spectrum.
If you could, in elevator pitch 30 seconds or less to put people's minds at ease that they're not going to be taken advantage of, for being fiscally responsible.
The biggest takeaway I would hope that people are able to walk away with and understand to dispel a lot of these clickbaits and headlines that we scan by and digest is that high credit borrowers are still going to receive more competitive interest rates than low credit borrowers. What these changes do are make the spread between the pricing adjustments for low and high credit borrowers a little bit more equitable, but not to any significant extreme. We are going to continue to reward those who have made smart fiscal decisions, but also the FHFA needed to evaluate risk and where risk lies. So they found some of those pockets and they added in some additional costs for those borrowers with higher credit scores, while lowering those for borrowers with lower credit scores. But as we talked about in the beginning, we all start with the same base interest rate. And while let's say I have a 620 credit score, right? And I'm putting 3% down to buy a home. The pricing adjustments on my loan right now are going to be 1.5%, not equating directly to an interest rate adjustment. For you, you're going to be a 0.5% if you had a 740 credit score. So there's still a really healthy spread to account for taking the right steps with your credit. But this is a change that has been lobbied against by the industry because there are ongoing concerns about housing affordability. But unfortunately, I don't see them reversing these changes. And for most people buying houses, unless they are able to find a portfolio lender or if they're in what's called jumbo financing, so they're not buying homes within the Fannie Mae, Freddie Mac loan limits, this will not affect them at all. Traditionally, borrowers with lower credit scores have borne a disproportionate burden in the loan level pricing adjustments that they're absorbing for their profile. These changes are now making it a little bit more equitable across the board so that we can lower the barrier to entry for homeownership.